In 1929, Jesse Livermore, one of the greatest traders in history, made the equivalent of $3 billion in a single week by shorting the stock market crash. He was on top of the world. 5 years later, he had lost everything. He eventually took his own life. Making money requires optimism, risk-taking, and boldness. Keeping money requires the exact opposite: humility, fear, and paranoia. And that contradiction is why most wealthy people don't stay wealthy. This is Chapter 5 of The Psychology of Money: Getting Wealthy versus Staying Wealthy. This chapter introduces one of the most important ideas in the entire book. Getting money and keeping money are two completely different skills. They require different mindsets, different temperaments, and different strategies. And most people only have one of the two. Think about it. To get wealthy, you need to be optimistic. You need to take risks. You need to put yourself out there. You need to believe that your business will work, that your investment will pay off, that the future will be better than the present. Without that confidence, you'd never start. But to stay wealthy, you need the opposite. You need to be a little bit scared, a little bit paranoid. You need to constantly think, what could go wrong? What if the market crashes? What if my business model breaks? What if I'm wrong? Morgan calls this the survival mindset, and he argues that survival is the most underrated financial skill. Because here's the math. If you earn 20% returns for 10 years, but then lose 50% in year 11, you're basically back where you started. All those years of growth wiped out by one catastrophic loss. But if you earn a modest 10% for 20 years without any major losses, you end up far, far ahead. Getting rich is about offense. Staying rich is about defense. And defense wins championships in sports and in money. Let's look at our first story. Jesse Livermore, the greatest trader who lost everything. Let me tell you the full story of Jesse Livermore, because it's one of the most dramatic cautionary tales in financial history. Jesse Livermore was a legendary stock trader in the early 1900s. He started trading at age 14. By his 20s, he had already made and lost several fortunes. The man had an almost supernatural ability to read the market. In 1929, while everyone was celebrating the roaring bull market, Livermore saw the crash coming. He bet everything on the market going down. And when it did, when the Great Depression hit and destroyed millions of families, Jesse Livermore made $100 million. In today's money, that's roughly $3 billion. In a single week. While the rest of the world was panicking, he was collecting the biggest payday in trading history. He was a genius. He was right. He had won the ultimate financial game. And then he lost all of it. Livermore couldn't stop. The same aggression, the same risk-taking, the same boldness that made him $3 billion, he kept using it. He kept making massive bets. He kept swinging for the fences. Because that's what had always worked. But the market doesn't reward the same strategy forever. By 1934, Jesse Livermore was bankrupt. And in 1940, he walked into the cloakroom of a hotel in Manhattan and ended his life. He left a note that read, "My life has been a failure." A man who made $3 billion called his life a failure because he mastered the art of getting wealthy, but never learned the art of staying wealthy. Let's look at our second story, the long-term capital management disaster. Morgan also references another incredible story in this chapter, long-term capital management, or LTCM. LTCM was a hedge fund started in 1994. Its founders included two Nobel Prize-winning economists. The team had PhDs from the best universities. Their mathematical models were considered flawless. For 4 years, the fund was printing money, returns of 21%, 43%, 41%. Investors were throwing money at them. They were managing over $100 billion. And then, in 1998, Russia defaulted on its debt. LTCM lost $4.6 billion in less than 4 months. They nearly collapsed the entire global financial system. The smartest people in the room, but still, they nearly broke the world economy. Why? Because they planned for everything except the one thing they couldn't predict. They had no survival plan, no margin of safety. They were so confident in their offense that they forgot to play defense. Now let me bring this into the present, because this getting rich versus staying rich trap isn't ancient history. It's happening right now. The rise and fall of WeWork and Adam Neumann. Let's talk about Adam Neumann and WeWork. This is one of the most spectacular flameouts of the last decade. Adam Neumann co-founded WeWork in 2010 with a simple idea: shared office spaces. He was charismatic, visionary, incredibly persuasive. He convinced investors that WeWork wasn't just a real estate company, it was a tech company, a community company, a change-the-world company. By 2019, WeWork was valued at $47 billion. SoftBank's Masayoshi Son poured billions into it. Neumann's personal net worth was estimated at over $4 billion. He owned multiple mansions, a private jet, and was preparing for an IPO that would make him even richer. He had gotten wealthy, spectacularly wealthy. And then came the question this chapter is all about. Could he stay wealthy? The answer was no. When WeWork filed for the IPO, the financial documents were made public, and the world saw something shocking. The company was burning through cash at an insane rate. It had lost $1.9 billion in a single year. Neumann had structured deals that enriched himself at the company's expense. He had trademarked the word "we" and charged his own company $5.9 million to use it. The IPO was pulled. The valuation crashed from $47 billion to about $9 billion almost overnight. Neumann was forced out as CEO, and by 2023, WeWork filed for bankruptcy. A company once valued at $47 billion is now bankrupt. Adam Neumann's problem was textbook chapter 5. The same traits that made him successful, the audacity, the risk-taking, the move fast and break things mentality, destroyed him when the situation required caution, discipline, and survival thinking. He never shifted from offense to defense. He kept spending lavishly, kept expanding aggressively, kept making bold bets when the moment called for pulling back, conserving cash, and playing it safe. He confused getting wealthy with staying wealthy. And here's the painful irony. If Neumann had been even a little more conservative, if he had controlled costs, grown more slowly, built actual profitability, WeWork might still be thriving today, and he might still be a billionaire. But he couldn't stop being the aggressive founder. And it cost him everything. Compare that to someone like Brian Chesky of Airbnb. Similar industry, real estate, and hospitality. Airbnb also faced a massive crisis. COVID-19 wiped out 80% of their bookings almost overnight in 2020. But instead of doubling down on aggression, Chesky did the opposite. He cut costs. He focused on core markets. He simplified the product. He played defense. And Airbnb went public in December 2020 and is now worth over $80 billion. Same era, same industry, two founders. One played only offense. The other knew when to switch to defense. The results speak for themselves. So how do you actually develop this survival mindset? Morgan gives us 3 principles in this chapter. Principle 1, be financially unbreakable. More important than big returns is making sure you can survive the bad times. Because if you can survive, if you can stay in the game, then compounding will do the rest. This means having an emergency fund, not being over-leveraged, not putting all your money in one investment, being able to absorb a hit without being knocked out. Principle 2, plan on your plan, not going according to plan. Every financial plan needs a margin of safety. You don't plan based on the best-case scenario. You plan based on things going wrong, because they will. Morgan says, the most important part of every plan is planning on your plan not going according to plan. If you expect everything to go perfectly, you have no buffer. When reality hits, Principle 3, be optimistic about the future, but paranoid about what will prevent you from getting there. This is the balance. You need optimism to invest, to start businesses, to take action. But you need paranoia to survive the obstacles between now and that bright future. Believe that the stock market will go up over 20 years, but be terrified of the crash that might come next month. That combination of long-term optimism with short-term caution is what separates people who build lasting wealth from people who build and lose it. This chapter answered a question I've had for years. Why do so many lottery winners go broke? Why do so many athletes, celebrities, and even successful entrepreneurs end up with nothing? And the answer is, they only learned how to get money. Nobody taught them how to keep it. And honestly, after reading this chapter, I started admiring people who drive normal cars, live in normal houses, and have investment accounts that would shock you. Those are the people who've mastered both skills, getting wealthy, and staying wealthy. There are 3 takeaways from this chapter. First, build a financial buffer before you build financial ambitions. Before you chase high returns, make sure you can survive low returns. Emergency fund first, insurance in place, debt under control. Only then do you start playing offense. Defense comes before offense. Always. Second, assume things will go wrong. When you make an investment, ask yourself, what happens if it drops 50%? Can I survive that? If the answer is no, you're taking too much risk. Your investments should be sized so that even in the worst scenario, you can stay in the game. Third, change your mindset as your wealth grows. The strategies that help you earn your first lakh are not the same strategies that help you protect your first crore. As your wealth grows, your tolerance for risk should shrink. Shift from offense to defense, from growth to preservation, from boldness to caution. That's Chapter 5, Getting Wealthy versus Staying Wealthy. The chapter that teaches you that the hardest part of the money game isn't making it, it's keeping it. In the next video, we'll cover Chapter 6, Tails, You Win. It's about why the vast majority of your financial results will come from a tiny number of decisions. Like this video if it gave you a new way to think about money. Subscribe and turn on notifications. We're building something special with this series. And tell me in the comments, do you consider yourself better at making money or keeping money? Be honest. See you in the next one.